Most people think that the stock market is like a casino. Heads you win, tails you lose. There's always this risk on, risk off kind of mentality, and it doesn't help that a lot of financial institution intermediaries also encourage activity within your stock portfolio. You know, you try to time the market, you try to buy at the low and sell at the high kind of thing, and yeah, it's something that I hope to change with this video, and I'm going to show you there's one particular metric that I focus for my own portfolio and my client's portfolio that I think can eliminate 95% of the noise out there. So welcome to those new to the channel. My name is John. I was a former engineer turned full-time investor. I'm also a wealth planning director at Phillip Capital Malaysia, and I'm the author of an upcoming book called The Malaysian Multi-Baggers that has returned 10 to even 100x certain shareholders that have benefited from the ride. It should be out in Q1 2026. So think about your conversations whenever you meet a financial market intermediary. So this is a very big term. So who do I mean by intermediaries? Either your stockbroker, your relationship manager in the bank, or some guy trying to sell you some unit trust funds. Just picture the conversation you have with them. They'll tell you things like target price, things like market sentiment, things like, oh, market outlook, and this is the themes that you should look at. Oh, the Federal Reserve increase interest rates here and there again. What is the next quarter earnings? You should buy before earnings announcement and try to profit from the upside. But in reality, to make serious money, all these are, from my point of view, my honest opinion, these are really, really short-term noises. And what you really want, if you want to be a serious contrarian investor and earn serious money, is really the quality of the business. What do you know about the business? Can this business be sustainable over the next 5, 10, 20, 30 years? I love companies that exist 100 years. There's this particular company in the US, it's been compounding 10% every year in terms of earnings growth over the past 100 over years. And it's just crazy. A business lifespan, if you can outlast 10, 20, 30, 40, 50 years, you consider already a great business. And if we are going to invest and to make serious money, it's really from that compounding effect that I was talking about. So if you're a fan of Lord of the Rings and you've watched the entire series, you realize that there is one very important theme, which is the ring that commands everything. And the Gollum was trying to protect this ring. So I draw that parallel to a particular number that I've come to realize over my years of investing, through the mistakes I've made and also the successes I've made, which is this particular quantitative number called return on invested capital. Now, don't worry if you don't understand it. I'm going to explain it to you with an example. So there's two numbers that I look for. One is cash flow from operations rather than net profit, rather than revenue. And also this number called the return on invested capital, or ROIC for short. Let me give you investors' explanation or business owners' explanation of ROIC. Think of it as the interest rate that the company pays itself. Okay, I repeat, interest rate that the company pays itself. So the analogy I would give is, if you are a CEO and you're going to spend 100 million to build a factory, and the factory can return to you 20 million in profit every year, that's a 20% ROIC. So return on invested capital, simplified formula is really your net profit or your total income, right? Divided against whatever capex or money you spend to actually grow the business. So it could come in the form of capex by building factories, or a certain R&D costs that you use to build a better product and things like that. So whatever a company spends to actually grow and to scale, and you divide that cost against what kind of profits or operating cash flow you can generate, that somewhat is ROIC. Obviously, there's a few ways to calculate ROIC, but I'm just putting the simple concept out there for you guys to understand it first. So if you draw something even more simpler, a parallel to fixed deposit. So if you put in 10 million fixed deposit and you get let's say 100 million fixed deposit, and you get a 3% yield on it, 3 to 4% yield. That's one example or one parallel I can use. A bad company, I wouldn't say bad. I would say most companies or most businesses in the world, it's not easy to generate double-digit ROIC. Most companies, on average, generate anywhere between 5 to 6 or sometimes even worse in terms of ROIC because they don't have pricing power, they don't have a durable competitive advantage. I'll explain this later. But yeah, to find a company that can generate anything above double-digit return on invested capital every year over the past 10 years, if you find one, hang on to it really tight because those are very, very rare. Very, very rare companies. And that's why when we structure portfolios for our clients, we actually scour the globe because in Malaysia, it's quite a struggle to find companies that generate ROIC more than 15-20% every year over the past 10 years. Why we view this as a very important number is because your stock returns will inevitably converge to the company's long-term ROIC. Actually, there's a simplified saying that your share price return will actually really converge to either your free cash flow or your net profit over the long term. So if your net profit is not growing and is stagnant, that's why valuations will either dip because there's no growth, or if you're going to buy something and hope that it becomes $20, you buy $1 and it hopes to become $20. But if the earnings don't follow through and don't actually manifest itself, then what you're actually buying a story or a pipe dream that will not manifest or will not realize itself. So that's why for us, what we try to construct the portfolio is we try to find stocks that give us, long term. It doesn't need to be like 50-60% ROIC because any business that can generate such returns will inevitably attract a lot of competition, and their competitive advantage will be slowly, eroded, and it will come to an equilibrium. So we try to find anything that, as long as it's double digit and we look at the quality of the business and then we think it's a fair valuation, that's something that we would want to include in our portfolio. So eventually, a company who is generating 5% ROIC will definitely lose out to someone generating 15, 20, 30% kind of ROIC returns over the long run. So my strict rule is 15% 10-year ROIC. That means they have to compound return on invested capital 15% every year over the past 10 years. It may be 16, maybe 17, it may be 15 on the dot, or it may be 14 on 1 or 2 years. Obviously, you have to apply some subjective judgment over there. But at 15%, it gives me a bit of buffer against inflation, against management execution mistakes, against rising cost of doing the business. And these kind of companies, this group of companies that can generate that kind of return, what I consider the business elite. Not many companies. Just to give you an example, one companies that I've owned over the past 9 years? No, more. 10 years. 10 years. It's a company that you and I are very familiar with. It's called Apple. At the peak, I think they were generating ROIC of 50-60% a year. Obviously, it doesn't happen every year, but there were times when they were generating ROIC of 50-60%. That 2 or 3 years. So these are examples of what I call the business elite. If you can generate ROIC of that kind of number, you really belong to a very elite group of companies around the world. Because if you think about capitalism and doing business, the capitalism is really brutal. If you make huge profits, competitors will come and want to steal you because they say, oh wow. I mean, look at what glove companies actually, what happened to glove companies. Prior to COVID, China, they were doing a lot of other interesting things. They had the scale, they had the speed, they have the determination and discipline to go into any business. But they actually kind of, ignored the glove business. But because of national security, because of, at that time, the peak price of gloves, it actually warranted them to say, hey, let's give it a go, because they were seeing companies like Harta Lega generating 20-odd% net profit margins, and Top Glove generating maybe 10-15% kind of net margins, and say, hey, if we do this at scale and we can lower our costs, and then our national interest serves it very well, why not? And what happened to the entire glove industry was upended because competition came in, built manufacturing capacity at scale, and then just China alone, the distribution or the demand for it was so huge that it could pay back whatever investments they made during that short period of time. So for a company to maintain good ROIC, obviously there are many factors, but I would distill them down into what I call durable competitive advantages, or what we call business moats. So some of the moats we include, switching costs, some intangible assets that they have. Maybe it's a patent that protects that pricing. Maybe it's a network effect that if you have a particular platform or an ecosystem where people who want to use your product and service have to be on board, and it's very difficult for them to come out of that network, then these are, I say, competitive advantages that help maintain a company's ROIC. I'll give you two examples of companies that have one high ROIC and one low ROIC. So as you can, if you followed my content before, and if you haven't, there's a video I did on Asia and why it was one of my big investing mistakes, investing into airlines. I put the link probably on the left or the right. Okay, so let's look at the industry. What is the airline industry, and how does the unit economics actually work? So in airline, you have to buy planes, which are very, very expensive, very capital intensive, right? And then for you to attract clients to get on board and to fly with you, you have to keep the fare prices low. Now, over and above the capital intensity for you to buy the planes, one of the biggest headaches for an airline is actually fuel costs, which is 50-60% of your operating costs. So imagine high initial cost for buying planes, and then ongoing high cost for fuel, and sometimes if fuel prices go up to more than $100, you struggle to actually try to maintain your fares, because you are trying to discount your fares as much as possible to fill up your planes. And if your planes are not filled up to the brim, then you may even lose on every flight because of the fares you charge. So you see, expensive planes, expensive operating costs, then price war on between different especially low cost carriers. You earn very thin margins. So that's why ROIC is actually sub 6%, right? And this kind of businesses, as an investor, it actually destroys capital. You contrast that with maybe someone in the medical field, maybe a device manufacturer, maybe a hospital that provides healthcare services. Now, when you are at your most vulnerable, whether you have a critical illness or maybe when you're sick, and you go to a hospital, I doubt that you will start haggling or discounting the price of what you're going to pay for the medical service, or maybe the machines that a hospital buys, right? These are almost like an inflation-proof kind of business. Obviously, insurers, people who pay for insurance, including myself, we have to bear the brunt of this inflation, medical inflation. But this is an example of where ROIC will be high because they have pricing power. Maybe they spend a lot of money upfront on R&D to patent a drug, to go through clinical trials. But then the moment the product is a viable product, there's a commercial demand for it, there is some kind of pricing power. And with pricing power means it's a little bit more, inflation proof. And I think that's where the ROIC will eventually be much, much higher than compared to the airline industry. So these are just two contrasts of high ROIC and low ROIC industries. Now, why is this ROIC number not spoken often enough by your brokers, your financial intermediaries? It's because high ROIC companies are usually very boring. They don't have any exciting news every week. They just compound quietly. They don't need to show off their capability to grow. And if you think about the incentive structures for most financial institutions, they want activity. Because how do they make money? They earn from trades, whether you sell on a losing position or buy in a losing position and all that. They just want activity and they want churn. And if you buy and hold over the long term, it's not going to be beneficial for any of these guys because the incentive structures are just geared differently. If you like the activity of going in and out and treating it like a casino, then that's your choice to make. But if you want to make serious money from investing, ironically, it's very boring. It's like watching paint dry and watching grass grow. And because of the inactivity, I think that's why it's not often spoken around among financial intermediaries. Actually, more often than not, they will give numbers like the P is too high, or now is a good time to enter because broad market is low, and all this kind of so-called market data. But when you hear all this, then you feel that a lot of this is important, like fund fed rate and whatever. But if you think about the quality of the business, like the medical example I gave you, you think that they're going to decrease price if the Federal Reserve or our Malaysian Central Bank cut interest rates? I highly doubt it lah. I highly doubt it lah. And that's what I really mean about the quality of the business. If you understand that industry, that sector, and you know that have that kind of pricing power, then will the macroeconomic factors impact it? Maybe over the short term, maybe when COVID happened, maybe people are tightening their belt or whatever. But after that, what happens? It bounces back. The medical inflation anywhere in the world, don't just look at Malaysia, anywhere in the world, it's something that's really inflation proof, for the lack of a better word, and that benefits us as an investor. So what's your takeaway from this video? Obviously the ROIC number, but I want you to start not looking at the stock price. Every time you get a stock idea or you want to do some research before buying a particular stock, stop focusing on the stock price. Look at the business quality first, and one of a very good number that you should look at is actually ROIC and actually cash flow from operations or operating cash flow. Because once you see that the company is very efficient with their investments and how they grow the business, you kind of get a hint of a moat or particular competitive advantage that this company has. And the number, high ROIC number, is actually a proof that it is actually efficient in how it scales and grows the business. So the point I'm trying to make is really, when I invest in the stock market, I'm actually buying a portion of a business. And when you only have a limited amount of capital, you want to focus on businesses that shows exuberance of quality. You want to find something that can help you compound. It may be slow, maybe like 5-10% every year, but if you can compound for 20, 30 years, obviously I'm not that young anymore, maybe for my kids, but if you can find a high quality compounder and you just let it roll, that's where real money is actually made. So if you don't know the ROIC, average ROIC of stocks in your portfolio, maybe you should really take a look at your portfolio and your strategy, reevaluate the strategy that you have. And if you want to do a portfolio audit, be my guest, let me know, no obligations. This is something that I do for all my clients, and hit me up either through a DM or in an email in the link below. So I'll see you guys in the next video.